The stock market can feel like a roller coaster. Ups and downs, twists and turns, it can be exhilarating and terrifying all at once. Right now, we're in a period of relative calm. Some might even call it uncertainty, but beneath the surface, powerful forces are building. These forces suggest that a bull run, a sustained period of rising stock prices, is on the horizon. In this exploration of the market, we're going to delve into the reasons why this bull run is coming. Before we get into the nitty-gritty of economic indicators and market trends, it's important to understand where we are right now. The stock market is a forward-looking beast. It doesn't react to what's happening today, it reacts to what it anticipates will happen tomorrow. So to understand why a bull run is coming, we need to first understand what the market is currently factoring into its calculations. Is it pricing in a recession? Is it anticipating continued growth? By answering these questions, we can start to see if the market is being overly optimistic or, as we believe, overly cautious. The stock market has been on a roller coaster ride over the past few months. We've seen periods of strong gains, followed by sudden dips, leaving investors feeling a bit queasy. This volatility is a reflection of the uncertainty that's permeating the global economy. Inflation, interest rate hikes, and geopolitical tensions have all contributed to this jittery market behavior. Investors are trying to make sense of a complex and rapidly changing landscape, leading to a lot of back and forth in the markets. One of the most significant factors weighing on the market in recent months has been the performance of the tech sector. Tech stocks, which had been darlings of the market for years, have faced a reality check as interest rates rise and growth slows. Earnings reports from some tech giants have disappointed investors, leading to sharp sell-offs. The market is adjusting to a new era of higher interest rates, which makes it more expensive for tech companies to finance their growth. Section 3. The inflation equation, a balancing act. Inflation has been the economic buzzword of the past year, and for good reason. Rising prices have put a strain on consumers and businesses alike, prompting central banks around the world to raise interest rates in an attempt to cool things down. This aggressive monetary policy tightening has been a major source of uncertainty in the markets. Investors are trying to gauge how high interest rates will go and how much economic damage they will inflict in the process. This uncertainty has contributed to market volatility as investors weigh the risks and rewards of different investment strategies. Section 1. Echoes of the past. Identifying bull market triggers. To understand where we're headed, it's helpful to look back at where we've been. The stock market has a rich history filled with cycles of booms and busts, each offering valuable lessons. History may not repeat itself exactly, but it often rhymes, and the stock market is no exception. By examining these historical patterns, we can gain a better understanding of the forces that drive market movements. By studying past bull markets, we can identify common triggers and patterns that can provide insights into the present. These triggers often include a combination of economic, political, and social factors that create a favorable environment for growth. One of the most consistent triggers for bull markets is economic recovery. When an economy starts to recover from a downturn, it sets the stage for a new phase of growth and expansion. When an economy emerges from a recession or a period of slow growth, businesses and consumers tend to become more optimistic. This renewed confidence leads to increased spending on goods and services, which stimulates economic activity. Government policies and central bank actions also play a crucial role in fostering economic recovery. Measures such as lowering interest rates, implementing stimulus packages, and enacting favorable regulations can boost investor confidence and encourage market participation. This optimism translates into increased spending, investment, and hiring, which fuels economic growth and in turn drives stock prices higher. As businesses expand and hire more workers, consumer spending continues to rise, creating a positive feedback loop that sustains the bull market. Additionally, technological advancements and innovations can act as catalysts for bull markets. Breakthroughs in technology often lead to new industries and opportunities, attracting investment and driving market growth. Global factors, such as international trade agreements and geopolitical stability, can also influence market sentiment. Positive developments on the global stage can enhance investor confidence and contribute to the overall bullish trend. In summary, identifying bull market triggers involves a comprehensive analysis of historical patterns, economic indicators, government policies, technological advancements, and global factors. By understanding these elements, investors can better navigate the complexities of the market and make informed decisions. Section 2. Riding the wave, the anatomy of a bull run. Bull markets typically follow a predictable pattern, albeit with variations in duration and intensity. Understanding this pattern can help investors position themselves to benefit from the upward momentum. The early stages of a bull market are often characterized by skepticism and uncertainty. Investors, still scarred from the previous downturn, are hesitant to jump back in, and the market tends to move higher in fits and starts. However, as economic data improves and corporate earnings beat expectations, sentiment gradually shifts from pessimism to optimism. Section 3. From tech boom to housing bubble, lessons learned. Examining past bull markets like the tech boom of the late 1990s and the housing bubble of the mid-2000s provides valuable lessons for navigating the present. These periods of rapid economic growth and subsequent decline offer a wealth of insights into market dynamics and investor behavior. Both bull markets were fueled by a combination of genuine innovation, loose monetary policy, and speculative fervor. The tech boom was driven by the advent of the internet, which promised to revolutionize the way we live and work. Meanwhile, the housing bubble was propelled by easy access to credit and the belief that real estate prices would continue to rise indefinitely. The tech boom saw an explosion of internet companies, many with little more than a website and a dream. Entrepreneurs and investors alike were caught up in the excitement of the new digital frontier, leading to a surge in initial public offerings and skyrocketing stock prices. Investors, captivated by the promise of the internet, poured money into these companies, driving valuations to unsustainable levels. The frenzy was further fueled by media hype and the fear of missing out, as everyone wanted a piece of the next big thing. When the bubble burst, many of these companies went bankrupt, and the Nasdaq Composite Index, heavily weighted towards tech stocks, plunged by over 75%. The aftermath was a sobering reminder of the dangers of speculative bubbles and the importance of due diligence and sound investment strategies. Similarly, the housing bubble's collapse led to widespread financial turmoil, highlighting the risks of excessive leverage and the need for regulatory oversight. Section 1. The GDP growth engine, fueling the bull. Gross domestic product, or GDP, is like the economic report card for a country. It tells us how much a nation is producing, selling, and overall, how healthy its economy is. A strong GDP growth rate is a major indicator of a bull market on the horizon. Why? Because when the economy is humming, businesses are expanding, people are spending, and that translates into higher profits for companies, which, you guessed it, leads to higher stock prices. Section 2. Jobs, jobs, jobs. The unemployment litmus test. The unemployment rate is another crucial economic indicator to watch. A low unemployment rate signals a strong job market, which is a key ingredient in a bull market recipe. When more people have jobs, they have more money to spend. This increased consumer spending fuels economic growth and boosts corporate profits, ultimately driving stock prices higher. It's a virtuous cycle that benefits both Main Street and Wall Street. Section 3. Consumer confidence, opening the wallets. Consumer spending accounts for a significant portion of economic activity. When consumers feel confident about the economy, they're more likely to open their wallets and spend, which, as we've established, is good news for the stock market. Consumer confidence is typically measured by surveys that gauge people's feelings about the current and future economic conditions. A high consumer confidence index suggests that people are optimistic about their job security, income prospects, and overall financial well-being. Section 4. Corporate earnings, the bottom line on growth. At the end of the day, the stock market cares about one thing above all else: earnings. Corporate earnings represent the profits that companies generate from their business operations, and they are the lifeblood of the stock market. When companies are profitable and their earnings are growing, investors are more likely to buy their stocks, driving up prices. Conversely, when earnings disappoint, stock prices tend to fall. It's a simple equation: higher earnings equal higher stock prices. Section 1. Riding the bull strategies for a rising market. Investing during a bull market can be exhilarating. It's a time when optimism abounds and the potential for profits seems limitless. However, it's important to approach a bull market with a clear strategy to maximize gains and manage risk. One popular strategy is to buy the dips. This involves purchasing stocks during temporary market pullbacks, taking advantage of lower prices. The idea is to buy low and sell high, capitalizing on the market's upward trajectory. However, this strategy requires careful timing and a strong understanding of market trends. Section 2. Diversification. Spreading the risk, spreading the wealth. The old adage, "Don't put all your eggs in one basket," rings especially true in investing. Diversification is essential for managing risk and maximizing returns, especially during a bull market. Diversifying your portfolio means spreading your investments across different asset classes, sectors, and geographies. This reduces the impact of any single investment on your overall portfolio, cushioning it against market volatility. Section 3. Sector Spotlight. Identifying bull market winners. While diversification is essential, it's also worth paying attention to sectors that historically perform well during bull markets. Identifying these potential winners can provide opportunities for outsized returns. Technology, healthcare, consumer discretionary, and financials are sectors that often thrive during periods of economic expansion and market optimism. Technology companies benefit from increased business spending on software, hardware, and cloud services, while healthcare companies see increased demand for their products and services as the population ages and healthcare spending rises. Section 4. Staying ahead of the curve. Monitoring the market's mood. Investing in the stock market is a dynamic process that requires ongoing attention and adjustments. Staying ahead of the curve means monitoring market sentiment, economic indicators, and company-specific news to make informed investment decisions. One way to gauge market sentiment is to track investor sentiment indicators, such as the Volatility Index, also known as the Fear Index. The VIX measures market expectations of future volatility. A high VIX suggests increased fear and uncertainty in the market, while a low VIX indicates complacency. Section 1. The bull is at the gate, preparing for the run. The anticipation is palpable, and the energy is electric. Investors and analysts alike are gearing up for what could be a monumental shift in the market. We've covered a lot of ground, examining the economic indicators, historical trends, and investment strategies that point to a bull run on the horizon. From GDP growth to consumer spending, the signs are all there. The data paints a picture of an economy ready to surge forward. While the market can be unpredictable in the short term, the evidence suggests that the stage is set for a sustained period of growth. Analysts are cautiously optimistic, noting that the fundamentals are strong. The market's volatility may cause some jitters, but the long-term outlook remains positive. The economy is showing resilience, with strong GDP growth, low unemployment, and rising consumer confidence. People are spending more, businesses are hiring, and factories are buzzing with activity. This kind of economic environment is fertile ground for a bull market. Corporate earnings are exceeding expectations, and technological innovation continues to drive new opportunities. Companies are not just meeting their targets, they are surpassing them. Startups are flourishing, and established firms are expanding their horizons thanks to groundbreaking technologies. These factors, combined with historical patterns, suggest that the bull is not just coming, it's practically at the gate. The momentum is building, and the market is poised for a significant upswing. Investors are ready, the economy is primed, and the bull is about to charge. The question is, are you prepared to ride the wave? Section 2. Your financial future. Seizing the opportunity. The stock market can be a powerful tool for building wealth, but it's not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. Don't get caught up in the hype or let fear dictate your decisions. Remember, bull markets are not without their risks. Corrections and periods of volatility are inevitable. But by diversifying your portfolio, staying informed, and managing your risk, you can weather any storms and come out ahead in the long run.